Good morning to our UK audience and good evening to our Australian audience participants. I'm delighted today to welcome you to this webinar, Raising It Right. Understanding and making sense of raising funds and navigating banks and finance is a daunting and complex task, particularly in a new market. Identifying the best type of funding and how to structure your company is crucial. This webinar will bring together experts from MHA and Freeths LLP in conversation about how to raise it right, accessing funding in the UK. MHA's Head of Banking and Finance partner, Greg Taylor, has a wealth of experience in supporting overseas companies set up and establish themselves in the UK. And Naomi Spring, an experienced corporate lawyer from Freeths LLP, specialises in UK fundraising and investment. Now, a bit about Greg. He heads up the banking and finance at MHA, and it offers debt advisory, banking consultancy, and also acts as a commercial finance intermediary, helping businesses who need to raise finance. He has 25 years financial services experience, having worked in senior positions for both bank-owned and independent finance houses before joining MHA in January 2015. And he works with a wide range of companies, including owner-managed businesses, SMEs and corporate clients across many sectors. And a bit about Naomi. Naomi is a managing associate with Freeths LLP. She's an experienced corporate lawyer in the highly regarded London team and specialises in business matters relating to UK fundraisings and investments, venture capital and cross-border M&A and private equity, joint ventures, refinancing, reorganisations and restructurings. She also advises on general corporate advisory and shareholder matters. Greg and Naomi are going to be doing a tag team on a number of these important topics today. There will be questions to follow, so please do put your questions into the Q&A on Zoom, and I'll hand over to Greg.
Thank you, Jo. Good morning, good evening, everybody. So we're going to take a whistle-stop tour as best we can in 40 minutes through some very complex issues and structures. I think what I would say to start with on my part would be that certainly on the finance side, my idea is to give you some guiding principles today. Now, clearly, individual business scenarios may change some of those principles, and so therefore this is a catch-all rather than an individual scenario presentation. If you do have an individual scenario, that it may be slightly different, so please reach out and we're happy to chat through any individual scenarios. If we could have the first slide up, please. Here come the slides. Yeah, next one, please. So just a little bit about MHA, BTI and Freeths in a couple of slides. It just goes to show the reach that we have, the international reach that we have, 148 territories, 706 offices across a multitude of different countries and territories, as you can see. So we really can offer an international touch to the business and a one-stop shop for any business that's looking for an all-round accountancy stroke solicitors firm, professional advisory. Next slide, please. And the same with Freeths. Again, 12 offices nationwide across the UK, 161 partners, and again, a massive amount of turnover, a highly regarded solicitors practice that again, can offer top of the notch advice. Next slide, please. So I didn't want to start off on a negative note, but I think it was important that we obviously understand some of the high level macroeconomic conditions in the UK if you are going to start a business in the UK at the moment. Obviously, clearly, lots of you already know these, but I think it's important that we just run through them. So Bank of England monetary policy increased interest rates in December to 3.5%. That was the 9th rise in interest rates this year and takes it to the highest that it's been in 14 years. Again, there's always flip sides to these things. So obviously, interest rates at 3.5 from my point of view. I remember when I got my first mortgage, it was at 6.15. So I don't think 3.5% is particularly high, and money was very cheap beforehand. So it didn't really need to go up at some point. It was kind of inevitable. I think the issue for the UK economy has been how quickly those rises have come, particularly latterly since August. They've come quite quickly, and therefore that has caused some turbulence in the funding markets around pricing. Pricing is, difficult for financiers at the moment to price in what may happen with any future rises. I think that the good news again on that point is that from everybody that I've spoken to in the various different financiers that we deal with and banks, that we expect probably interest rates to peak at around 4 by the spring of 2023. So they're not massively going to go up anymore. So I think if you're now coming into the UK market, now is probably a good time to do it. It's not going to get any worse. If anything, hopefully by the end of the year, we should hopefully, maybe, I don't have a crystal ball, but start to come down again. So, rates are reasonable. In terms of inflation, again, 10.7%, it's high everywhere across Europe. The UK is doing better than a lot of our European neighbours in regards to inflation. And again, many economists believe that the UK has passed its inflationary peak, which is obviously artificially inflated due to the same as the rest of the world, energy prices, fuel prices, the war in Ukraine, and food and drink costs. The insolvency numbers, again, a bit of a weird one to put in, but I thought it was worth noting that there's been quite a steep increase in the number of insolvencies. Now, there's two factors at play here. Clearly, there was an issue around COVID support and the amount of debt that businesses took on during COVID. And we're starting to see, I think, some of the effect of that COVID debt, because they weren't grants, it was debt. And therefore, some of those businesses obtained loans that perhaps under normal circumstances wouldn't have been lent. And I think the other thing there is that obviously, because there was a hiatus in terms of the insolvency laws and what could happen in order to put a business into insolvency to protect jobs during the pandemic, we are seeing a bit of a sorting of the wheat from the chaff, that there were quite a few businesses, I would suspect, going into COVID that were probably on the edge, that were saved because of the debt and because of the insolvency laws. And therefore, we are seeing a bit of sorting from the wheat from the chaff at the moment. But I think also, if you're looking to come into the UK market, that may well present opportunities for you. So for acquisition, first and foremost, whether that be a share purchase or an asset purchase, but there are some decent businesses that have got some debt on that you could leave that baggage behind and pick up if you're coming into the UK market as a complementary to what you're currently doing, and get your foot in the door of the UK economy. Next slide, please. So in terms of the current market conditions, excuse me. So the latest data from UK Finance indicates a slowdown in lending. Now that's not driven by the lenders not wanting to lend. I think I wanted to again make that very clear, that there's good appetite within the lending market in the UK to want to lend to the right business. That's being mostly driven by companies that aren't tending now to take development finance for development and growth finance of their businesses, but are more tending to take it for working capital requirements. And therefore, we're seeing a slowdown, particularly in things like term lending. And as you can see from the slide, things like overdrafts and invoice finance, asset-based lending is increasing. Bank appetite remains good. Assets generally are king in the UK at the moment. So banks and other lenders like to lend against assets rather than against the balance sheet. But balance sheet lending is still available. And there's a good mix in the UK of traditional high street banks, international banks, challenger banks, fintech lenders, and alternative lending, which is obviously, fintech alternative lending was one of the saviours of the 07-08 credit crunch. And so fundamentally, there's a lender for pretty much every opportunity. It's about matching it up. It is quite a wide market, which I'll come on to when we talk a little bit more about ourselves in a short while. The next slide, please. So accessing working capital and how to access working capital. So the first thing I'd say, and you've read the first bullet point on there, and I'm sure he would say that, is please use a professional advisor. We see lots of opportunities where people haven't used a professional advisor, And again, not saying you can't do it yourselves, but there may be a better solution. There are lots of businesses out there lending money, niche lenders, for example, international banks, that aren't accessible without coming via a professional advisor, or they just may not be household names that you're aware of. And therefore, you know, coming via a professional advisor, it will save you time, it will save you money, and more often than not, you will get the best and the right facility for your business. You must have a UK bank account to receive funds from a UK lender for the initial drawdown. Sounds easy, but we'll come on to bank accounts in the UK. That's probably one of the stickiest areas that I'll cover today. It is quite hard opening a bank account in the UK at the moment for lots of different reasons. Having a UK director will make it a lot easier when you're opening a UK bank account. That is one of the prerequisites. We deal with a lot of international businesses. We tend to have a UK director as our recommendation. If a PG is therefore required, a personal guarantee, then obviously it's between the directors, but in lots of cases you can get a separate bit of paper drawn up between you behind the scenes, where the UK director takes the PG, but he is covered by the other guys, the other directors that are offshore. So, but a UK director is really helpful and will definitely strengthen your case when accessing working capital in the UK. Good experience and a strong track record. It doesn't have to be in the UK, it can be in Australia, it can be in the States, it can be in various other countries around the world, but having good experience and a strong track record, another business in the background for argument's sake, and again, we'll talk about using guarantees, overseas parent guarantees later on, but again, that can definitely happen. And a well-capitalized balance sheet if assets aren't available. As we said, assets are king. Banks and other lenders like to lend against assets in the UK. That is one of the strongest areas in which we lend. And therefore, it's always good, if you don't have that, to have a strong capitalized balance sheet to show you've got some skin in the game. I think going back to the broker permissions, if you are going to use a professional advisor, then there are certain professional advisors with certain qualifications that I would use. So you're looking for a credit advisor that has FCA permissions for credit broking, and one that is associated with either NACFAB, the National Association of Commercial Finance Brokers, or FIBA, the Financial Intermediary and Broker Association. I thought I'd put up 3 useful websites for you. So in terms of grants, there are lots and lots and lots of grants in the UK, mostly around technology and that kind of stuff. And therefore, there's a website there so that you can find some grants that are relevant to your part of the business. UK Export Finance, if you're importing, exporting, the purpose of UK Export Finance is to stand between you and the lender, and they will provide a government guarantee to the lender. If the lender likes the proposition but is a bit nervous, then the government will step in and provide a guarantee to try and encourage exports and imports into the UK. And then the British Business Bank. If you are starting a business from scratch, it's a brand new business, the British Business Bank is the place to go to for the startup loan scheme. You won't get a cheaper startup loan than at the British Business Bank. You can borrow up to £25,000 per director. The British Business Bank is not a bank in the true sense of the word. It's more administrative from that sense, and it hands out government funds first and foremost. So that's my part covered. I will now hand over to Naomi, who will cover some sections from a legal perspective.
Thanks, Greg, and a big hello to everybody. So as mentioned, just briefly, I'm from Freeths, which is a leading national law firm in the UK. We have over 12 offices and a large network of lawyers. And if you'd like to reach out at any point after this presentation, you can do so by finding me on Google's. Just type in Naomi Spring and Freeths, and it should pop up. But moving on to what I'm going to cover today. So I am delighted to talk to you today about the UK equity funding market and potential tax reliefs that may be available to equity investors in the UK, and then move on to the different legal structures you can use to operate your business in the UK. So to kick off with the equity funding piece, The funding process will look slightly different depending on the stage that the company is at, and the stages of funding can broadly be categorized as follows. Firstly, the pre-seed funding round, which is basically money received from founders, family, friends, and high net worth individuals, so business angels. Secondly, you've got the seed funding round, which is the first official stage of funding in the UK from external investors, so typically venture capital specialists. And then finally, the more formal stages of funding are called the Series A, B, C, etc. Rounds, when you can expect involvement from more sophisticated institutional investors wishing to scale up the business towards an exit. What I would say is, if you are thinking about raising equity in the UK from external investors, then a really good place to start is the ICAEW website. That is the Institute of Chartered Accountants in England and Wales. And on the corporate finance page of the ICAEW, you can find a link to their corporate finance partners. And a lot of these partners are very well known and reputable business organizations in the UK, and their websites contain a lot of information on networking events, the latest news in funding circles, and a lot of other information and resources on equity investments. One very well-known organisation which is on that website is the British Private Equity and Venture Capital Association, or the BVCA for short, which has available to everyone as a free resource a full set of model documents for early stage investments, including a term sheet in that pack as well. So these documents are very well known and accepted in the UK market. And if you are doing an early stage investment, it is worth asking your lawyers if they will be using these model documents as their starting point, and they can be a real time saver and cost cutter. If you are familiar with the UK equity investment market already, you may have heard about a couple of tax reliefs bandied around called SEIS and EIS. So SEIS stands for Seed Enterprise Investment Scheme, and EIS stands for Enterprise Investment Scheme. And these are two early stage tax reliefs which are available to UK individual investors, which are aimed at driving investment into small and growing businesses in the UK. So these reliefs have very specific rules, so we'd always recommend talking to your UK tax advisors about them. But broadly speaking, if they apply, then the individual investors can get very significant tax benefits, which can make early stage investment very attractive to them. So from a company perspective, if a company wants to attract SEIS or EIS investment, then the key thing to be aware of is the need to abide by the particular rules attaching to these reliefs, and the potential for the relief to be subsequently withdrawn if the rules aren't met. And some of those rules do include obligations on the company. And this often means that the legal documents will need to be slightly more prescriptive when these reliefs are being sought by investors. Separately, there are various other tax reliefs available in the UK for early stage companies. One of the most popular ones is called AMI, which is a tax efficient share option scheme for employees. Again, we recommend talking to your UK tax advisors if you're interested. Next slide, please, Janice. Thank you. So moving on then to legal structures for running your business in the UK. You don't have to have a separate legal entity. You can be incorporated outside of the UK and just have what we call a branch or place of business in the UK. There are some high-level filing and accounting requirements, but effectively you can just walk in on day one and commence trading if you want to. Unfortunately, it is not yet possible to do what we call a re-domiciliation in the UK. So that would be moving your Australian incorporated entity to over here whilst maintaining its legal identity. So just effectively swapping the jurisdiction of the entity to a UK entity. As I say, you can't yet do that, but the government is talking about bringing this in very soon. So definitely one to watch for the future. Alternatively, if you do want to go down the more formal route of setting up an entity, then you may choose to have a separate trading vehicle as a standalone entity or as perhaps a subsidiary company of an Australian or foreign parent company. And if you do want to do that, then it's pretty easy to do so. You can actually get a company set up within a day, for example, and there's only a small fee to pay at the company's registry, which is called Companies House. Next slide, please, Janice. So I've set out most of the main UK trading vehicles available on this page if you want to set up a new entity, and a comparison table of the differences between them. The most common two are the first two listed there, so companies and limited liability partnerships. And the main difference between these two vehicles is the governing constitutional documents. With companies, the main document is the articles or the bylaws, as they might be known elsewhere. And with limited liability partnerships, it's the partnership agreement. So as I say, that's the main difference, but they are similar in that they are both corporate bodies with separate legal personality, and the shareholders or the partners that own them generally won't have personal liability for the debts and obligations of the business because they are their own entities. You can get other types of partnerships as well, which are not separate legal entities, and for which the partners would be personally liable. And these are general partnerships and limited partnerships, but we won't go into detail on that here because these are typically more seen in a funds context. Next slide, please, Janice. Okay, so if you do choose to go with a company, then as Greg saying earlier, you do need to have at least one director. You also need at least one shareholder, although it can be the same person as a director. There's no maximum number of directors, and the minimum is one. And whilst there is no legal requirement for the director to reside within the UK, as Greg was saying, there might be reasons for needing one. So for example, the banks might require one. Worth bearing in mind that under English law, there is a concept of being a director if you are acting as one, even if you weren't officially appointed as one. So we call these shadow directors or de facto directors. There are a couple of nuances between the two terms there, but it's important to note because you could be a director if you're acting as one without knowing. And this means that you will have directors' duties under both statute and common law, and therefore potential liability if you breach those duties. And I've listed the main statutory ones on this slide. Now handing back over to Greg to pick up on some of the practicalities for new businesses in the UK.
Thank you, Naomi. So one of the stickiest things to try and do at the moment, one of the most difficult things to try and do at the moment from a finance perspective, is open a UK bank account. I can see there's a question in our questions and answers about bank accounts. It is a bit of a minefield. It has been like that for probably at least the last 18 months. It is taking some time for UK banks to open, as in the high street banks, to open bank accounts, but there are some alternatives. So we'll go into the alternatives in a minute, but in terms of the process and what banks look at. So to open a UK bank account, you may be able to get an account without a UK director or UK employees, but you will make it much easier for yourself, again, if you do have a UK director, as with obtaining finance, or if it's just a bank account, you're not obtaining finance, at least having UK employees. In terms of the complicated structures, again, define complicated structures. If you have multiple companies across multiple jurisdictions, then, particularly if we're treading into the likes of, some offshore territories like Cayman or something along those lines, UK banks will become slightly more concerned, and complicated structures do make it harder to open bank accounts. Similarly, and again, this point comes across to both of these in terms of shareholders being in a trust. It's a red flag to many bank accounts, and ideally you should avoid it if you want to open a UK bank account. The reason for both of these numbers 2 and 3 comes down to anti-money laundering and source of wealth in the UK, where the banks have to note down and record where the cash coming into the business, either from shareholders or who owns the business and where their wealth comes from. And it's much harder to track that back if we're going through complicated structures, shareholders being into a trust, etc., etc. Now, there is always an exception to the rule, as I said at the start. And in this case, my caveat on 2 and 3 would be that clearly the turnover within your business that is going to be going through in the UK or is going through in Australia at the moment, and any cash deposits that may be leveraged into the bank will have an effect. So less than 2 million turnover, forecast turnover in the UK, we would normally be looking at a fintech bank as a starting point to get a foothold into the UK. Anything above that, the high street banks would become much more interested. Point number 4, a well-established and profitable business in Australia is key. Also, a bank will want to know the rationale and story behind why the UK bank account is required. The last bit there is key. It has to make sense. So we have a number. One of the key things that we do within MHA, within the banking and finance team, I have an expert here that deals with bank accounts and opening bank accounts for businesses coming from abroad through the BTI network and outside of the BTI network. And we get lots of requests for bank accounts. And when we're asked why you want the bank account in the UK, we get told it's for tax purposes. It's not going to fly, I'm afraid. The bank is not going to open a bank account purely for tax purposes. It needs to be a better rationale than just for tax purposes. That can be part of the story, but it has to, as I said, it has to make sense. We have access to all the high street banks, as I said, some private banks, technology banks, and payment service providers. So we can provide you with an honest overview of what may or may not be possible. Again, it depends what you want from your bank. If you just want to retain funds in the UK and pay funds out of the UK, then quite possibly a payment services provider will be more than sufficient for you to open an account with. If you do need more additional services on top of that, backs, payments, FX, various other different things that you require that a bank needs to provide, overdraft, lending facilities, argument's sake, those sort of things, then again, we will have to go to one of the technology banks, the private or the high street banks, and again, they'll have different levels of entry into those particular sectors. Next slide, please. I'll hand back over to Naomi.
Thanks, Greg. So if you have a place of business over here or an established presence, then you probably will need to register with the UK's tax authority called HMRC for corporation tax purposes. But note that even if you don't have a base in the UK, there may be some circumstances where you need to register with HMRC. So for example, if you supply any goods or services to the UK, or you expect to the next 30 days, then you may need to register with HMRC for VAT purposes, and VAT is being the local consumer tax in the UK. There may be other authorities that you need to register with as well. So one example is the Information Commissioner's Office, which is also called the ICO. This is the authority in the UK which is in charge of safeguarding personal data. So if you are a UK company processing personal data relating to UK individuals, then it is highly likely that you will need to register with them. When it comes to foreign companies, the legislation actually doesn't specify and is very unclear, but if you are a data heavy company that is again controlling UK personal data, then there may well be a case for registering. And if you'd like to know more about any of that, then I'd be happy to put you in touch with one of our data protection specialists at Freeths. Next slide, please, Janice. So moving on now to the final piece of the presentation, which is the challenges and potential barriers to entry. And there are lots of different areas that we could cover here, depending on the sector that we're talking about. In general, however, I would say that the UK has a fairly stringent regulatory environment, and from a funding perspective, if you are raising money, even if it's just from early stage investors, you could be caught by the financial promotions regime, which is a regime enforced by our financial conduct authority over here. Even if you are just sort of taking steps to persuade somebody to invest by putting out a slide deck with particular details. And therefore, we always recommend, again, talking to your UK advisors to see if you could fall within this and how you could deal with it if so, or how to avoid it altogether. Lastly, on this slide, it would be wrong not to mention it, but Brexit. So the overabundance of red tape introduced and additional border controls since Brexit took effect has caused some physical supply chain issues, delays and increased costs, etc., in terms of access to the to the EU from the UK. And these issues has of course been exacerbated in more recent times by the pandemic and the situation in Ukraine. And to combat this, we have seen a move by some UK businesses to use supply chain strategies such as stockpiling and over ordering on goods, as well as increasing the prices to customers. However, what I would say is that the EU remains the UK's main trading partner for both imports and exports, and actually exports have dropped significantly less than imports into the UK from the EU since Brexit, which suggests that trading outwards to the EU is still strong. Handing back to Greg now for the final slide.
Thanks, Naomi. So some challenges, again, some barriers to entry, particularly around what lending covenants we would see typically in the UK, and security requirements for lending from banks and other financial institutions. So standard business lending security in the UK is always an all assets debenture. So that covers all the assets of the business. So a fixed and floating charge effectively, so debtors, chairs, tables, anything else that the business effectively owns, IP, would be covered under that debenture. And then personal guarantees / short form indemnities. So a personal guarantee normally and clearly has a monetary value attached to it. A short form indemnity does not necessarily. A short form indemnity means that providing you don't commit fraud or something along those lines, should the business fail, you can just walk away and the lender will pick up the pieces and work out what they're going to do to reclaim their funds. But if it's found that you have done something that is nefarious, then the short form indemnity would kick in. Clearly, as we've said in one of the previous slides when we were access to funding, taking director guarantees from non-UK directors is tricky in the UK for most SME lending. Once we get above SME lending and we're getting into corporate lending, then obviously we have much stronger financial institutions that are more technically advanced and have bigger legal departments, etc., and therefore cross-border lending into multiple jurisdictions is not a particular issue, and guarantees from anywhere in the world pretty much can be obtained and accepted. Can you use your overseas parent company, Australian company, as a guarantor? Yes, you can. But again, as a lot of what I've said, the overall proposition from a lending perspective needs to make sense and it needs to stack up. Really, using your parent company as a guarantor is the cherry on the cake for any lender. It isn't going to fundamentally make the difference between whether the lending is granted or not. But in my view, it may make a difference between what rate you get on the lending. It may make the proposition more sweet for the lender, and therefore they may be in a position on the risk curve to grant you a better risk reward rate on that basis. And then just finally, I thought it's worth having some standard covenants. I guess they're pretty similar around the world from what I've seen, but there are a few that may be particular to the UK. So CFADs, cash flow available for debt service. That is a particular one that is used by a number of the high street banks, particularly in the UK. It's actually the one that I don't like the most, to be honest with you. So there's a number of bits that go into that calculation, and one of the sort of the traps with that particular clause, or that particular covenant, if you like, is that it only affects the working capital movements in the last 12 months. That's what it looks at, and there has to be sufficient cash flow within that to service the debt. So cash in bank. So we had a business recently, they had a lot of cash in the bank, a lot of reserves they built up over a long period of time. They could have serviced the debt 3 or 4 times over. That wouldn't be included in the CFADs covenant. Only the working capital movements over 12 months would be included within that CFADs covenant. An EBITDA covenant, so earnings before interest, taxes, depreciation and amortization. And that's used as an indicator in the UK of overall profitability of a business. And usually a bank or another lender would require a minimum level of EBITDA to be maintained, as a must to be maintained. And then net worth, similar to EBITDA, it's another sort of test to see that the company's worth is the value of the assets after paying off all the liabilities like debt. And it's different. Please note that the net worth is different from the market value of the company or market capitalization. And again, a minimum level of net worth is normally required, particularly in any substantial lending where we're lending, more than £500,000. Usually 1, 2 or 3 of those covenants will be included. Again, we can advise on all of those and provide guidance for you in an individual circumstances. But it's always worth checking your legal documents for your lending. I'm always amazed at the number of clients that have just signed them and then not quite sure exactly what covenants the bank have put in. And obviously you need to make sure that you can meet those particular covenants. And I think that comes to the end of the formal part of the presentation, and we can move on to questions, Jane.
Great. Thank you, Greg and Naomi. What an excellent overview that was. There's quite a number of questions that people want to ask. So I'll start with the questions that the audience want to ask, and then I've got a couple of my own that I'd like to ask. So we've got a question from Jeff Bowman, and he says, which UK sterling area banks are the most likely to open sterling bank accounts for/to lend to Australian-owned businesses over here in the UK? As an Australian CA doing UK Australian international tax in London for 35 years, this is a very difficult issue for clients. So which sterling banks are most likely to open sterling bank accounts for Australian-owned businesses?
Okay, so I don't, it's difficult to say that there would be a particular bank that would be more likely or less likely to do it. It does come down to the individual circumstances of that business trying to open the bank account in the UK, as we went through the various different parts of, you know, what banks look at when they're opening a bank account. And clearly, you know, the more of those we can tick or cross appropriately, the more likely you are to get a bank account. But, you know, particularly at the moment, we're finding that the likes of HSBC are quite open to open bank accounts at the moment. So HSBC would be one that I would mention. Certainly, NatWest aren't interested at all. I'm not speaking out of turn. If it's international, not Australia, it's not personal. It's just that they're not opening bank accounts for international businesses at the moment. But I think that HSBC would be my first port of call, but happy to look at the individual scenario and provide some advice at a more granular level.
Great, thanks. Naomi, do you have a view on that?
I think, as Greg said, really, not much further to add. I've also heard that HSBC are pretty good on that kind of thing.
One of the areas that I've found has been quite attractive to individual investors, even family offices, has been, you know, the whole EIS, SEIS tax breaks. And I think family offices are a growing area for the place, you know, place to go for funding. Have we got any comments on that? Do you want to go into the tax break in a bit more detail, or
yeah,
you know, what's been your experience?
Yeah, of course, no problem. So I should just start off, short disclaimer, because lawyers love a disclaimer. I'm not a tax lawyer, so I won't sort of go into too much depth, but broadly speaking, so there's SEIS and EIS, and SEIS is the one that applies to smaller investments. So we're talking about investors putting in, you know, 100 grand or perhaps a couple of $100,000, and the tax reliefs that you can get are something like up to 50% of the amount invested. You get income tax relief for, and also the opportunity to exempt the capital gain totally on the SEIS shares. And then with EIS, it's very similar. Again, you get the opportunity to exempt, subject to certain conditions, the EIS shares from the capital gain altogether for the period that you hold them. And the income tax relief for the individual investor for that one is 30%. But as I say, there are conditions and rules around eligibility. There are maximum caps on the amount that can be invested and that kind of thing. So it is an area where if you're going to go down that route, you just need to look carefully at the rules. It's not super complicated. It's just a matter of making sure that you're abiding by them and the documents say the right things, so that the company and the investor does the right things to get the relief.
Great, thanks, Naomi. Greg, did you want to add any further comment to that, or?
No, tax is a minefield. Take advice. Take advice.
Take advice.
Take proper tax advice from a lawyer, and also from an accountant.
Great. Although it is it's an increasingly attractive way of raising funds, so it's definitely worth getting some advice on.
It is. Yeah. And again, there's particular sectors, particularly for EIS, where EIS applies, and there are other industry sectors where EIS doesn't apply. So again, you need to do your homework before you venture out.
Yeah. Good. We talked a bit about using the Australian parent company as security. So just a question again, can I use, reiterate that point, can I use the Australian parent company as security, and will that help on the success of my application?
Yes, you can. Obviously depends on the strength of the Australian parent company, but yes, you can use it as security. My overriding view, as I think I said in the presentation, is will it make the difference to the loan or the debt being granted or not being granted? No, I don't think it does. But ultimately, it may make a difference to the rate that you're charged, the interest rate that you're charged for those funds, and therefore, it's worth putting it in. Also adds obviously another layer of protection for you as well. So if you're a personal guarantor and you've got the Australian parent company in as a guarantor as well, then clearly you're going to add, helping to protect yourself as well as secure the lending.
Great, thank you. Anthony Lillyman. He hasn't got a question, but he's got a tip. You might want to comment on it. And he says, for startups and small businesses, if you have to give a director's guarantee, UK entity, to get a loan, then there's some reasonably priced director's guarantee insurance products. And what's your thought about looking at them to decrease your exposure?
Okay, so my honest view is, yes, they work. They do work, but they don't kick into the full value on day one. They tend to build up over a period of time. You also have to provide, as you would with a bank loan or guarantee, a pack of information on a monthly or quarterly basis. And therefore, as with any insurance product, if they see it going the wrong way, they're going to start to withdraw the insurance. So where it really helps is if you get that big bang effect, so your main debtor goes bust and the company just suddenly disappears out of nowhere, they will protect you. But if it's a slow decline over a period of time, unfortunately, as with all insurance, it's going to start to be removed. So they are worth looking at, but it isn't a silver bullet.
Great, thank you. Matty Ball has said that they are a UK company newly trading in Australia, and they'd like to know, is there a funding or seminar the other way from UK going into Australia? So that would really, I suppose the question there is, what links do you have the other way to assist people that want to go from the UK to Australia?
There's the chamber, so I guess you could advise on what you've got there. But equally, we've got member firms from an MHA perspective, pitch partners in Australia, and they would be more than happy to, they've got a similar person to myself in their particular practice, and they'd be more than happy to advise to Matty on that particular subject and pick up his individual case.
Yeah, it's the same at Freeths as well. We've got a number of best friend firms around the world, and we are a member of the Baker Tilly network. And we can easily, reach out to our friends and colleagues in those other jurisdictions to help take any query forward on that respect.
Great. It's a question arising out of your comments about securing a UK director, and it's more of an opinion piece, I think. So what, in your opinion, do you think makes a good UK director? I mean, if you don't know many people in the UK and you're thinking, well, where do I go? Where do I start to find a good UK director? Have you got some thoughts on, what type of qualities, etc., that companies should be looking for a UK director? And particularly when they don't have contacts in, those kinds of contacts in the UK.
So there's a number of places you can go. So the FD Centre would be a place that you could go, and again, they have various contacts, and they can act as UK directors for you if you want them to. It comes at a cost, but clearly, they've been vetted and various other bits and pieces. So, and again, they'll have contacts that you can reach out to. We've got various contacts that will come in as directors as well, whether that be as FDs, whatever the case may be, that are looking for positions. and clearly the same as bringing any employee, so to speak, on board. Obviously, a director is an employee necessarily, but you know, you're going to be looking for somebody with ideally experience in their field, somebody that understands the market that you're wanting to work in, both the sector and the jurisdiction, and then any other qualities that you feel that you would require on top of that, depending upon what the particular role is. Obviously, there's lots of different sort of brands or flavors of directors, whether it's a sales director or a finance director or a commercial director, or if you're in America, a vice president. So you know, it really depends what you're looking for, I think.
Naomi, did you want to comment on that? Or?
Yeah, one thing just to flag is the roles on corporate directors. So the rules around this are being tightened. I know in other jurisdictions you can have just a single corporate director on the board, but over here, I think the current position is that if you have a corporate director, you've got to have real directors on the board as well. And I know that the government has been looking at this recently. So just one to be aware of. And as we were saying earlier as well, for practical reasons, it's obviously easier that director resides in the UK themselves.
Good. And Greg, you talked about, you know, you're seeing some acquisitions just from your experience at MHA. What are you seeing? Any particular sectors making more acquisitions? Are you seeing more activity, you know, in one sector or another sector? What can you comment on there?
Yeah, so we're seeing it across the board. Clearly, there's you know, the areas that have been most affected by COVID, so hospitality, leisure, that kind of stuff. There's some good opportunities there. I would say also in terms of the construction industry, again, there's some good opportunities in that particular sector. But we're also seeing some very big beasts selling off some parts of their business as well. So, you know, the post office, for example, we've seen a number there where they've sold them off. DHL have sold off a bit in the UK recently, et cetera, et cetera. So there seems to be quite a lot of activity on the M&A sector-wide, you know, sector agnostic, quite frankly, across the board.
Yeah, I'd agree with Greg on that one, particularly in the private equity arena. Activity, M&A activity remains strong across the board. Private equity investors obviously have good access to different types of funding. So as I say, generally sector agnostic, but outside of that, in terms of trade, M&A, the sectors that are probably most prominent still, things like tech, and ones where possibly a slight decrease in activity, although some people are saying just a tail off from COVID, are retail and real estate.
That's very helpful to know. One thing earlier was a question about you said you could set up a branch or an establishment and not necessarily have to have a company. Do you think that makes it easier or less easy to secure a bank account? I mean, are the banks looking for really companies, or it doesn't really matter?
Yes, companies. That's nice and easy. Yes, companies. Yeah, branch isn't going to fly. Yeah, they want ideally limited companies or limited liability partnerships is the two main areas, which, you know, PLCs, LLPs or LTDs is really what we're talking about.
Okay, great. All right, well, we're coming to a close of the webinar. Thank you so much, Greg and Naomi. It's been very, very helpful. Of course, you might like to just say a couple of words, Greg and Naomi, to sort of sum up, you know, what are your quick hot tips for setting up in the UK? So we'll start with Naomi first. Hot tips.
Thanks very much. So on the equity funding front, hot tips are: go to the ICAEW website, have a look at their corporate funding page. You can get a lot of further information from there. BVCA really, really good place for model documents, although make sure you discuss them with your lawyer. If you're looking to attract SEIS and EIS investment, then be sure to make sure that you're in the right sector and abiding by the rules. Otherwise, the investors could be very unhappy when their relief is withdrawn. And finally, if you are going to set up, probably, as Greg just said, you're looking at a company or an LLP as the easiest vehicle to set up as.
Thank you. Greg?
I would say have a UK director. You'll make your life so much easier. I would say that if you are looking to gain funding in the UK, having a strong Australian company in the background will assist. The track record will be really interesting and useful to any UK bank looking to lend. And last, but by no means least, I would say take advice, not just from a professional advisor, but UK Export Finance, the British Business Bank, the other websites that we put up on there. They offer some really useful, free, impartial advice, and they'll be able to point you in the right direction of where to go.
And of course, you're always available, aren't you, Greg and Naomi, to take any questions, etc., from the audience. Please, we encourage you to contact MHA and Freeths. We thank them very much for sponsoring and supporting the webinar. This is the second